Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello and welcome to Business Line's State of Economy podcast on global economy and strategies. I am Lokeshwari, and today we are joined by Benedek Vörös, Director, Index Investment Strategy, S&P Dow Jones Indices. Today we'll be taking a look at the global active versus passive investment debate and whether international investing is the right way forward in these market conditions. Hello Ben, welcome to Business Line State of Economy podcast.
Thanks very much. It's a pleasure to be on.
Okay, to start with, I'd like to ask you that the SPIVA, that is the S&P Indices Versus Active report, has been leading the active versus passive debate over the last 2 decades, as we all know. So can you share some key learnings from these reports over the years with us?
Yeah, absolutely. So SPIVA, as you already mentioned, stands for S&P Indices Versus Active, and it's a series of now 9 regional and semi-annually published scorecards that compare the performance of active equity and in some regions, including India, also fixed income, so bond mutual funds, against an appropriate benchmark over various time horizons, starting from 6 months, 1 year, 3 year, 5 year, 10 year, and in the case of the United States, even 20 years, as you mentioned. Mm-hmm. And if we look across the key learnings or the key takeaways across regions that encompass the United States, Australia, Canada, Europe, India, Japan, Latam, South Africa, and the Middle East and North Africa, what we found is that over the past 20 years, most active managers had underperformed their appropriate benchmarks over a full market cycle. Of course, there are variations across shorter periods, and I'm happy to go into later on what might be driving these cycles of outperformance and underperformance. But if you look at the entire market cycle, most managers underperform their benchmarks. And another key theme is that that's been consistent across the regions that we cover is that underperformance rates generally rise with the length of time period that we study the performance of mutual funds. And there are good reasons for that. There is an excellent blog by my colleague Craig Lazara on our Indexology blog, which is freely available to everyone. So if I'm allowed a very brief promotion, I would encourage everyone to follow the blog. It's excellent, but he very well explains eloquently in a new blog why it is the case. But in a nutshell, the skill persists over time, but luck dissipates, and as a result, the underperformance rates tend to be increasing over the time periods under study.
Mm-hmm. That's interesting. So you're saying that the active fund managers are struggling to outperform the indices across regions. That's kind of uniform. So do you think it's because of the inherent uncertainties that are built into the equity investments themselves? Or do you think there are other factors that are affecting this?
Yeah, so based on our own academic studies and also the study of full-time academics, we can identify 3 key reasons, which are structural reasons that drive the underperformance of active managers over longer time periods. And these factors, which I will go into more detail one by one, is the first is the professionalization of the investment management industry, the inherently higher cost structure of active management compared to the passive alternatives. And the most interesting, or at least, and probably the least understood by investors, is the skewness of stock returns. So let's take a look at each of these one by one. Yeah. So the first one is the professionalization of the investment management industry. And what is really important to realize is that the investment management industry is a zero-sum game in the sense that there is no natural God-given source of outperformance. So someone's alpha or positive outperformance is someone else's underperformance. And that is the source of alpha is coming from below average investors. And what that means is that as the average level of skill of players getting ever higher, and there are like many fun indicators of that which we track, like from starting from the number of CFA charter holders to the number of Bloomberg terminals that are in use, or the percentage of AUM managed by funds as opposed to individual investors or amateurs. But all these metrics that we track point to the direction of the professionalization of the investment management in industry, and that means that means two things. One is that the absolute level of the players in the industry is getting ever higher. And second, the relative skill difference between various players also gets compressed. And counterintuitive, there is a fascinating academic paper on that, which basically dissects this phenomena in great detail by a Columbia University academic called Michael Mauboussin, called The Paradox of Skill. But it goes into great detail of why, as the average level of absolute skill increases and the dispersion of skill between the good and the bad players gets narrowed down, outperformance is becoming ever more difficult and elusive, I would say, as well. So that's the first factor. The second one is just costs. So low cost, I think it's probably the reason which is the simplest to understand. So of course, active managers incur many of the costs like research, more frequent trading, management fees, the costs of company visits, and so forth, which makes it inherently more expensive than passive investing. And as Albert Einstein said, compounding is the eighth wonder of the world. And these costs, which means is that even if any single year this cost difference doesn't sound like a huge one, like for example in the US we made a detailed study on that, and in 2021, for example, there was a 0.62%, so 62 basis point cost difference between the average expenses of an active fund and an average expense ratio of passive funds. So it doesn't sound much, but if you compound it over years and over decades, it really adds up, and it really puts active managers at a very significant disadvantage. And the third reason, which I found personally the most fascinating, is but also probably the least understood, is the very strong positive skewness of equity returns. So if you look at like the normal distribution, I guess everyone studied it at school, which is just basically a bell curve, which with 50% probability of a given observation falling above average and 50% falling below the average. But if you look at long-term stock returns, you see a distribution which is very far from the normal distribution. So just looking at the example of the S&P BSE 100 index for that in the past 10 years, between December 31st, 2012 and December 30th, 2022, what we can observe is that the median return, which means that basically that half the stocks returned more than that and half the stocks returned less, was 54%. But the arithmetic average is 137%, which is over twice as high as the median return. And what that means is that if stock returns would be normally distributed, then it would mean that if you pick any random stock from the BSE 100 in this case, there would be a 50% chance, as I mentioned, of that particular stock delivering above average performance. But if you look at but if the distribution is skewed, like what we see in the stock market, this stock picking or selection becomes much harder. So due to the turnover of stocks in the index, there were actually 337 stocks that at some point were part of the S&P BSE 100 index in the 10 years leading up to December 2022. But out of the 337, only 87 have actually beaten the BSE 100, which means that if you randomly pick the stock from these 337 stocks, there was only a 26% chance that this particular stock has outperformed the index, and not 50%. Which means that stock picking is really an uphill struggle, and it's very challenging because a few massive large winners carry much of the weight in delivering long-term returns in equity markets.
Mm-hmm. This skewness, is it also being seen in short-term period? Like if you see just 1 year period, you still see this kind of 50% of stocks outperforming and 50% underperforming?
In shorter time horizons, it is less acute, and randomness plays a much larger role over 1 year horizon. So it can vary, and it's much closer to 50%. But as again, like it's just the power of compounding, and also just by the nature of a share or a piece of share, which is a limited liability instrument, meaning that the maximum you can lose is 100%, but you can gain 100, 200, 300,
Yes.
1,000, or even in the India market, there are many 100-bagger, so to speak, 100-bagger
Yes.
companies which go up 100 times. So just by this nature of stock as an investment vehicle, having limited liability, and maximum downside is 100, and maximum upside can be like 10 times, 20 times, 100 times even, means that over long-term horizons, the distribution of returns is getting more and more skewed. So if over very long horizons, there was a study done by a US academic called Bessenlinder in the US, and what he found is that it was a study for around 100 years. Of course, the US stock market has the longest history in the world. Just 4% of stocks in the US delivered basically the entire positive real return in US markets, which means that it's like finding a needle in the haystack. And of course, you can try to do that, but you have to realize that it is very challenging, and odds are against you.
That kind of explains why the fund managers are struggling so much. I mean, it's more of a game of a chance, the way you're putting it. So I'd like to ask you, what is the experience with fixed income funds? Because the conversation mostly is around the equity funds. So fixed income, how is this performance versus benchmarks?
Yeah, it's an interesting segment of the market, for the reason that basically in fixed income markets, what we see is that there are certain sources of outperformance which tend to work most of the time. So it's quite often that we see in global markets that let's say 9 years out of 10 or 4 years out of 5. So in a relatively high percentage of years, a higher percentage of fixed income managers outperform the benchmark than in the case of equities. And as I mentioned, it's in large part probably due to the fact that two popular strategies. One is taking duration risk, and second, going down on credit quality. So like, let's say, including corporate bonds in a fund, even in a small proportion, which is benchmarked against a government index, tend to produce a pickup in returns in a more stable manner, I would say, than in equity markets. So it's unless there is a recession or a market turmoil, this credit exposure or long duration exposure often do deliver positive returns in a higher percentage of years. But again, like it's I wouldn't say it's picking up pennies in front of the steamroller, but it's still a fact that better performance for fixed income funds often come from taking additional risk compared to the benchmark that the given fund is measured against. And again, like looking at the full market cycle, including recessions, that the basic long-term tendency is similar in most of the world. That fixed income funds, looking at a 10-year time horizon, for example, tend to underperform their respective cycles once the years when there is a recession is taken into account. So just to look at the Indian market as an example, over the past 1 year, so in 2022, the majority of the Indian composite bond universe did in fact outperform our benchmark, which is the S&P BSE India Bond Index. But if you look at the 3-year plus time horizons, what you see is that the majority of fixed income funds tend to underperform the benchmark.
Mm-hmm. So coming to the market cycles itself, so do you see any trend of underperformance of active managers in certain market cycles? Because, for instance, I saw that in 2022, the large cap equity funds in US, the underperformance was much lower. And I saw the lower underperformance in 2007 as well, and in 2013 as well. So do you think some trends are there in bear markets, the underperformance of funds is lower or some such trend?
Yeah, absolutely. So it's an area where we have conducted extensive research, and there are indeed certain market environments when it is relatively easier for active managers outperform if they have the necessary skills. So we identified 3 main drivers that are conducive or that help active managers if those drivers are present in a certain market. So the first one is the dispersion of stock returns. And what dispersion means is it's a measure of how much the average stocks deviates from the index itself. So just to illustrate with an extremely simple example, if you have an index of 2 constituents, if the index is up 10%, it can achieve it if one stock is up 20% and the other one is flat, or both stocks are up 10% each, and that's how the index is also up 10%. So in the first example, dispersion is high because there's a 10% average deviation of performance between the index constituents and the index itself. And in the latter case, dispersion is low because both stocks or all stocks, which in this very simple example means 2, perform exactly same as the index. And of course, if what this means, and this very simple example illustrates, in the latter case, when dispersion is low, there is no reward for identifying better or worse performing stocks or stock. Basically, you do all the analysis, but if all stocks perform the same or very similar to each other, there is not much reward for you to identify the ever so slightly better performer. But if the dispersion is high and you successful in identifying the one that delivers 20% and avoid or underweight the one that is basically flat, then your exercise in company analysis and stock picking would be high. So that's the first condition that is helpful for active managers: high dispersion. Second one, we historically observed in many markets, and there are examples of that in the most recent SPIVA scorecards, is that if stock prices fall, active managers tend to have a lower underperformance rates, and it's due to the fact that the majority of active managers either have some cash buffer or cash holding. They tend not to be fully invested and just always leave a bit of dry power to both either to face redemption requests or to opportunistically pick stocks if they identify anything good. But what we observed is that a big majority or like a big proportion of funds just have few percentage allocation to cash not being fully invested, which means that if stock markets fall around the world, just like as you pointed out in the US, that was the case last year. The S&P 500 was down 18%. We tend to see lower underperformance rates for active managers. And the third interesting driver of active manager outperformers, or at least lower underperformance rate, which was also present last year in the US, if you mentioned the US, was that if the leadership of market is broad-based and less driven by a few extremely large winners, the active managers tend to do better. The reason for that is that active managers, again, it's a tendency that we saw across markets. They, on a relative basis, tend to underweight the largest constituents in a given index, and they tend to overweight the smaller constituents, which means that if the smaller stocks do better on a relative basis, like what was the case in most markets around the world last year, active managers tend to do better. So these are the three main drivers of active manager performance over shorter time horizons.
So there's a lot of talk about international investing these days, and people are looking at investing in other regions, other countries, and so on. So do you really think that international investing or global diversification really works? Because markets are so interconnected these days, with most markets moving together. What's your view on that?
Yeah, so there have been many studies, and we have a whole range of research papers and blogs on the topic of international diversification. We have a slightly dated paper on India, but we examine the same for Australia, for South Africa, and many other regions in the world. And what we do find is that that diversification, international diversification, does work, and there are several reasons for that. The first is that even if the global economy is more interconnected than it was a few decades ago, there are very distinct differences between the sectoral composition of any single market around the world, because every economy has sectors, or every country has sectors where it has strong firms and market-leading firms, and there are other sectors where the given country doesn't have a natural edge and is represented as a result with a much smaller weight in the index. So just, for example, if we take a look at the sectoral composition of the Indian versus the US stock markets, what we see is that Indian market, like if you take the broadest or a broad-based benchmark like the S&P BSE 500 index, has a very significant overweight in financials and materials, and a significant underweight in information technology and healthcare compared to the sectoral composition of the S&P 500. And various sectors behave very differently, even in the same economic environment. Some sectors are defensive, like consumer staples and utilities and healthcare, and some other sectors are cyclicals, like consumer discretionary, for example, which means that diversifying internationally would deliver diversification benefits just via giving exposure to different sectors of the stock. And the second impact is just coming from the fact that despite the increased interconnectedness of the global economy, there are still economic cycles which are moving in a different pace in various countries. For example, just to mention something different compared to India, but another emerging market is China. If you look at just the past few years, what we saw is that China was much more resilient in the initial part of the pandemic than global markets, but then it became a major laggard while the rest of the world was recovering. Or even if you look at shorter cycles, like between the end of October last year, when the gradual reopening started, until the end of January, China performed much better than global markets, or than the US or than India, and then the recovery sputtered over there. But even if we just return to the example of India, there have been multi-year cycles of performance and underperformance of the Indian market compared to the rest of the world. Like there was the demonetization drive, which triggered a significant underperformance of local markets, and in the most recent 3 years, despite this year's wobbles, we see a quite significant, actually, an annualized 9% outperformance starting from 2020 against the S&P 500. So there is certainly value in diversifying internationally, despite the greater interconnectedness of the economy.
But how does an investor go about using indices to do this international investing? Is that a right way to do as a tool?
Yeah, no, absolutely. So just to quote the Nobel Prize winner economist Harry Markowitz, who was the founder of MPT, which is modern portfolio theory, said that the only free lunch available to investors is diversification. And this observation is as true today as it was when he made it a few decades ago. And to implement diversification in practice, indices can be a very useful tool because they are rules-based, they are transparent, and they are also, as we talked about previously, are also a cost-efficient way for investors to gain exposure to a wide range of market segments, including regional equity benchmark like the S&P 500 or the S&P BSE Sensex in India, or particular sectors like IT and energy, and also as the third generation innovation indexing to various factors like low volatility or growth and value. And again, I can refer to a few academic studies in the region which examined the main drivers of returns in an internationally diversified stock portfolio, or actually an asset portfolio. And what study after study has confirmed is that the bulk of like 90% plus of the returns of a broad diversified portfolio is coming from picking geographical regions and asset classes, and the actual active part of picking the exact constituents in these broad asset classes and geographies are adding a diminishingly small contribution to the overall portfolio return.
Mm-hmm. For the last question, I'd like to know about equal weighted indices, because that's something that we are coming to hear more in India. It's a little bit relatively new in India. So equal weighted versus market cap weighted. So what are the pros and cons, and which one do you think is better for investors to follow?
Yeah, so equal weighted indices are relatively, I would say, old in the US. So the S&P equal weight just celebrated its 20th anniversary this year. So we did produce a range of materials to celebrate that anniversary, which again, I can again refer to our great blog, indexologyblog.com.
Okay.
But what basically equal weight indices do is that they include the same constituents as their market capitalization weighted indices, but rather than weighting these constituents by market cap, each company is allocated a fixed equal weight in the index at each rebalance date. So for the S&P 500, for example, that means that all 500 of the constituents have a 0.2% weight in the index, as opposed to having 20% plus in the largest few constituents. And this feature of equal weighting lends certain characteristics which are to the equal weighted versions of indices, which are unique to them and which strongly distinguish them from their market capitalization counterparts. First of all, it introduces if you look at, we have a great monthly product called the factor dashboard, which decomposes many, like more than a dozen S&P 500 factor indices into their key drivers. But if we zoom in into the S&P 500 equal weight index, what we tend to find is that it has a a bias towards small size and the value factor compared to its parent index, the S&P 500, which means that over long time horizons, the equal weight version of the traditional indices can take advantage of the so-called small size or small cap effect, which Fama French and their academic predecessors have widely documented. So to be slightly more concrete on the extent or the dimensions of this small cap effect, if you look at the 20 years from January 2003 to December 2022, so basically since the S&P 500 equal weight is live, what we see is that the equal weight version of the S&P 500 outperformed the main benchmark, the S&P 500, by about 1.5% annually, with the S&P 500 itself delivering 10% annualized return since January 2003, and the equal weight version delivering 11.5% return. In terms of sector composition, it also tends to, of course, overweight sectors with relatively smaller constituents and underweight sectors that have larger firms on average. So again, if you look at the S&P 500 and the S&P 500 equal weight, what we see is that equal weight version has a much higher weight in industrials, real estate, for example, and materials, whereas it's underweight information technology, healthcare and communication services compared to the main index. And it is also a interesting benchmark potentially that that investors in active funds may want to benchmark their investment manager against, because as again we discussed previously, the active management community as a whole tend to have a bias towards smaller stocks. As I mentioned previously, active managers as a whole tend to underweight the largest constituents of an index and tend to overweight smaller ones, which means that they have a slight bias, I would say, towards the equal weight version of a given cap weighted index. And we did actually, again, like don't want to push our website too hard, but just as a part of the 20th anniversary celebrations, we did run a SPIVA report, a special anniversary edition, which looked at the performance of active funds versus the S&P 500 equal weight index. So I encourage listeners who want to dig deeper to check out that analysis as well.
We'll definitely take a look at that. So thank you very much, Ben, for sharing your insights with us. It was very useful.
Thanks. It was a pleasure to be on, and I look forward to our next conversation.
Bye, everyone.